Imagine you have $100 in your savings account. Now here's a harsh reality. Inflation can erode the purchasing power of that $100 over time. If the annual inflation rate is 2%, after 1 year, your $100 will only be worth about $98 in terms of what it can buy due to rising prices. This process continues each year, quietly reducing the value of your savings unless your account earns at least a 2% return just to maintain its real value. Inflation is like a silent thief. It gradually erodes the purchasing power of your money. The real shocker. Many people don't even realize its impact until significant damage has been done. Here's how it works. Let's say you save $1,000 in an account with 2% interest. At first glance, that sounds good. Your balance grows to $1,020 by the end of the year. But wait a minute. Inflation is typically around 2% on average over long periods. So while your money grew by 2%, prices also increased by approximately 2%. This means that the purchasing power of your savings has effectively decreased because your interest rate did not outpace inflation. Now let's break it down step by step. Step 1, your account earns interest, increasing your total amount of money. Step 2, inflation causes prices to rise, which reduces the purchasing power of that additional cash. By the end of the year, you might have $1,000 in your bank account. But if prices increased by 3%, suddenly that $1,000 can only buy what $970 used to cost a year ago. You lost purchasing power without even realizing it. Here's the math. If your savings grow by 2% but inflation is 3%, your purchasing power drops by 1%. This results in a net loss of 1% in real value. Over time, this can be devastating to your wealth accumulation efforts. Let me show you why. If inflation remains at 3% and your account grows by only 2% annually, after 5 years, the purchasing power of $100 will decrease to approximately $86.26. This represents a loss of about 13.74% in buying power. Here's the kicker. While savings accounts are indeed insured up to a certain limit, this insurance does not protect your funds from the erosive effects of inflation. Your money's purchasing power can decrease over time as prices rise. Now let's talk about something even more shocking, long-term effects. Imagine saving $10,000 for retirement and expecting it to last decades. If inflation stays steady at 3%, in just 10 years, your $10,000 will only have the buying power of roughly $7,441, correctly calculated as $10,000 / 1 plus 0. 0310 equals approximately $7,440.96. That's a loss of nearly 25.6%. And if you're thinking, but what about investments? Hold that thought, there's more to this story. When people hear about stocks or real estate, they often get excited because these can offer higher returns compared to savings accounts. But here's the rub, most investments come with risk. You might earn a lot 1 year but lose it all the next. And even if you're lucky and your investments grow at an average of 7% annually after inflation, which is a common long-term historical return for stocks, inflation can still erode your purchasing power over time. Let's look at that $10,000 again. If you invest wisely and achieve a steady 7% annual return, a historically challenging but not impossible goal, after 10 years, your initial investment of $10,000 would grow to approximately $19,672. However, if inflation averages about 3% over those same 10 years, the purchasing power of that $19,672 would be significantly reduced. That $20,000 in buying power dwindles to roughly $14,508 over a decade, with an average annual inflation rate of about 3%. You may have earned money on paper, but you lost ground against inflation. Inflation is like a silent thief that diminishes the purchasing power of your savings without you noticing. However, there are ways to combat its effects, and they might be less daunting than you think. Here are some practical steps. First, consider index funds or ETFs. These spread your risk across many companies and sectors, potentially offering better long-term returns than a typical savings account while keeping risks relatively low. Second, keep an emergency fund in cash for immediate needs. But beyond that, put any extra money into investments designed to outpace inflation over the long term. Third, diversify your portfolio. Don't just rely on one type of investment. Mix it up with different asset classes such as bonds, real estate, and stocks to spread risk. Fourth, learn about inflation-indexed bonds or Treasury inflation-protected securities, TIPS. These securities adjust their principal value based on changes in the Consumer Price Index, thereby protecting your purchasing power from inflation. Now let's dive into a common myth. People often believe that keeping cash under the mattress or in a non-interest-bearing account is safer than any investment. But here's why it's risky. Over time, inflation can significantly erode the purchasing power of money left idle, meaning its value decreases as prices for goods and services rise. For example, if the annual inflation rate is 2%, an item costing $100 this year would cost approximately $102 next year. If you hold cash instead of investing in assets that can potentially grow faster than the inflation rate, your wealth can slowly diminish. Cash loses value as prices rise because its purchasing power decreases over time. If you store cash under a mattress or in a safe, you miss out on the potential growth that can be achieved through wise investments. A strategy to invest and grow your money is essential for beating inflation. Another myth: I'll just save more money. While saving more is good, it doesn't protect you from the eroding effects of inflation. For example, if inflation averages 2% per year, your savings would lose half of their purchasing power over about 35 years due to the compounding effect of inflation. And here's another crucial point. Your brain makes this harder than it needs to be. People tend to focus on short-term gains and ignore long-term effects like inflation, which is why understanding compound interest versus inflation is key. The boring option, sticking with a diversified portfolio, quietly outperforms the exciting one over time due to the power of compounding and reduced risk from diversification. But what about those get-rich-quick schemes? They sound tempting but often lead to significant losses. Remember, there is no guaranteed method to outpace inflation without taking on substantial risk. Every investment strategy comes with its own set of trade-offs, and it's essential to understand these before proceeding. So here's a quick recap. Inflation quietly eats away at your money every single year, reducing its purchasing power. Savings accounts typically earn interest rates that are lower than the rate of inflation, meaning their buying power diminishes over time. Smart investments offer better protection against inflation, even if they come with risks. Diversifying and learning about tools like TIPS can help you maintain the real value of your savings. In short, don't be fooled by the illusion that cash is always safer than investments. While cash may appear stable, it can actually cost you money over time due to inflation eroding its purchasing power. Quick reminder, this channel is financial education, not financial advice. Always conduct your own research and consult with a licensed professional for decisions regarding your finances. This has been the Money Files. This is educational and historical, not financial advice. So let's dive deeper into how inflation impacts your savings in real terms. Imagine you have $1,000 sitting in a standard savings account with an interest rate of 2%. If inflation is currently around 4%, your purchasing power decreases each year because the increase in prices outpaces the growth of your savings. Here's the math. If you earn 2% interest on $1,000, you end up with about $1,020 at the end of the year. However, if inflation is also 2%, it reduces the purchasing power of that extra $20 by approximately the same amount due to higher prices. Now let's look at an emergency fund scenario. If you need 6 months worth of expenses saved up and your monthly cost is $3,000, you'll have a total of $18,000 in savings. Over 1 year with 2% inflation, the same amount of money would only cover about 5 months and 2 weeks of living expenses. That's already less than 6 months, without even accounting for any potential price hikes. Inflation also hits big-ticket items hard. If you save up to buy a car that costs $20,000 today, by next year, the same vehicle might cost around $21,200 due to inflation, assuming an average annual inflation rate of 6%. That extra $1,200 is money you would have needed to set aside, reducing your purchasing power over time. Another key point: not all savings accounts are created equal. Some pay little to no interest, while others offer higher rates that may better match or slightly outpace inflation. However, even the best savings account typically cannot provide growth sufficient to keep up with long-term price increases, without taking on more risk through investments like stocks and bonds. Government bonds, especially Treasury Inflation-Protected Securities, TIPS, are a good option for those wary of stock market volatility but still want protection from rising prices. TIPS adjust their principal value based on changes in the Consumer Price Index, ensuring you maintain purchasing power by keeping pace with inflation. Over time, this can make a significant difference in preserving your real returns. Investing in real estate can help protect against inflation because rental income typically increases with rising rents, and property values generally appreciate over time. This appreciation helps serve as a hedge against inflation, as higher rental prices increase your income to match rising costs. Stocks can be risky, but generally offer higher returns compared to savings accounts or bonds. Companies often pass on rising costs to consumers through price hikes, which helps protect stockholders' purchasing power against inflation. Long-term investing in index funds that track broad market performance has historically outperformed inflation and provided substantial growth over many decades. Remember, the key is diversification. Putting all your money into one type of asset can be risky due to market fluctuations. Spreading investments across different types such as stocks, bonds, TIPS, and real estate can help smooth out some risks while still offering potentially better returns than a savings account or cash under the mattress. Inflation doesn't just eat away at your current savings. It also impacts future earnings and retirement planning. The longer you wait to start investing, the more inflation erodes potential purchasing power over time. Starting early and consistently saving can significantly improve long-term financial security by helping to offset inflation's corrosive effects on money value. So next time someone tells you cash is king, think again. While holding onto cash might feel safe, it quietly loses purchasing power due to rising prices. Investing wisely with a focus on diversification and understanding the impact of inflation can help preserve your wealth over the long term. In short, don't be fooled by the misconception that keeping money in a savings account protects you from economic realities like inflation. It's important to understand that maintaining real value and purchasing power over time requires considering factors beyond just saving in an account with low interest rates. This is educational and historical, not financial advice. Imagine you have $100 in your savings account, earning 1% interest annually. Now consider that inflation is running at 2%. In the first year, your money grows by 1%, but the cost of living increases by 2%. This means you're losing purchasing power even before accounting for taxes and other fees. Let's look at what happens over a decade. If you start with $10,000 in savings, after 10 years with an average inflation rate of 3% per year, your purchasing power would be reduced to approximately $7,441. That means the same goods and services that cost $10,000 today might cost around $7,441 a decade later. In other words, the money you're saving is slowly being eroded by rising prices. Think about a loaf of bread that costs $2 today. If inflation continues at an annual rate of 3%, in 10 years, that same loaf will cost approximately $2.98. Your savings aren't just losing value, they're actively falling behind the real-world costs you face every day. To combat the effects of inflation, consider investing your money rather than keeping it idle in a low-interest account. Historically, stocks and bonds have provided higher returns compared to cash over long periods, helping to outpace inflation. But remember, there's always risk involved. Diversifying across different types of investments can help mitigate those risks by spreading them out. In short, the longer you wait to start investing, the harder it is for your money to keep up with rising costs. The best defense against inflation isn't hiding cash under a mattress. Instead, understand how and where to grow your wealth wisely over time. This is educational and historical, not financial advice.